And we are live. Hello and welcome, Credit Warriors. I'm Dave from Versio, and today I brought with me a special guest. Let me just make sure my microphone is picking up, and it is. Okay. So my special guest has been in the credit industry for nearly 30 years, having worked for both FICO and Equifax. With over 2,000 media interviews and quotes and over 5,000 published media appearances, he is by far the most recognized credit expert in America. So let's welcome John Ulzheimer. There he is. All right, we got him.
Thanks for having
Okay,
me.
excellent. Okay, so we got a lot to cover in not a whole lot of time, and thank you, Warriors, for joining me today. Just to preface the call really quick, one of the reasons why we have John in Credit Warriors and why Supreme was gracious enough to say yes, we want to have the most recognized credit expert in the country come in and answer some questions, because there's just a lot of bad information out there. And I think that's part of what I spend my time trying to undo. And John, I know that's one of the things you get called to do quite a bit. So yesterday and the day before, we put up some posts asking people to give us some questions so that we can answer them live. And let me just do one thing here. There we go. All right. So I want to make sure everything looks good. Okay. So I see we've got some people on, and John, if you're ready, we're gonna go ahead and get into some of these questions.
Okay.
Now, before we do, one thing that I want to prep the group watching is, so John is going to be answering your questions and providing some great insight that is going to help you on your journey to better credit. It's important to clarify, John is a credit expert. He's not a credit repair expert. So what that means is, if you've got questions like, how do I delete this from my credit report? What's the right language? How do I... So that it's not going to be that kind of a call. This is a credit education call, answering your questions about how scores and credit reports work. Now, by all means, if you have questions like that, post them. I just won't present those to John in this live, and either myself or somebody from the admin team on Credit Warriors or a fellow Credit Warrior will answer the question for you. Okay. All right, here we go. So, John, let's start off with this question. Crystal Monroe asked, how do I get my actual FICO score for mortgage?
All right. So you may or may not know, but in the mortgage environment, the FHFA, which oversees Fannie Mae and Freddie Mac, mandates the use of not only FICO scores for mortgage underwriting, but also a specific generation of FICO scores. It's actually fairly old. It's actually almost 20 years old, the generation of scores that are used for mortgage lending. And that's not a criticism of FICO, and that's not a criticism of the credit reporting agencies. It's a criticism of FHFA, frankly. The only way to get those, there's actually two ways you can get those scores. Number one is you can pre-qual for a mortgage loan, which is actually a pretty easy way of doing it and is probably going to be free. However, it's going to leave inquiries on your credit reports because a mortgage broker is going to pull them. But then obviously you're going to see the legitimate scores that a mortgage lender is going to see if you were to go apply for a loan. The second way is not free, but it will not leave hard inquiries on your credit reports. My FICO, which is FICO's consumer division, actually will sell a package which is going to include tons and tons of their scores, including the scores that are used in the mortgage environment. So there's pros and cons, obviously, to both of the options. Those are the two ways to get them.
Yeah, I think I saw a post that followed this one saying, have your mortgage broker do a soft pull, but there really is no such thing from what I understand.
Well, some companies are set up by the bureaus to do what's called a instant pre-screen or a pre-screen of one. It's really the same thing. And it gives the ability for, like, auto dealerships can do this, or auto lenders can do this, not dealerships. Auto lenders can do this, and some banks can do this. And so they have the ability to actually allow for the accessing of a credit report under a soft inquiry for the purposes of trying to see if you qualify for some form of a loan. So certainly if your mortgage lender is representing to you that they have the ability to do one of these instant pre-screens or pre-screens of one, those do result in soft inquiries. But I'm going to caution you that they better get this right, because if they post a hard inquiry, then you have that issue to deal with.
Right. Okay, excellent. And okay, so Crystal, hopefully that answers your question for you. And Willa Strickland has this question. Okay, on one hand, credit card companies want you to utilize their cards responsibly, but they will also hold it against you if you don't charge enough. Let's tackle that one first, John. That's a package I'm going to have you unwrap for
Yep,
Willa.
kind of. It's like hypocritical nature of credit cards, right? So
Yeah.
I used to do a lot of presentations when I was back in the corporate world, and it was not uncommon for a credit card issuer to be a co-presenter with me, which was great because I wasn't the least popular guy in the room whenever a credit card issuer was on
Right.
stage with me making presentations. And I'm not going to identify the card issuer because that's not fair. But what he essentially said is that their favorite customer is someone who has a card, has had a card for a while, has a pretty high credit limit, is maxed out, pays late every once in a while, and goes
Yeah.
over limit every once in a while, but never defaults, because that is the most profitable credit card customer there is. That's a horrible thing for your credit scores, obviously, but from a
Right.
revenue perspective, that's something that's very,
Yeah.
it's very advantageous to the bottom line for the card issuer.
Right. 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 All right. Bottom part here, is there such a thing as being blacklisted from getting a particular card, even if you pay the entire balance once account entered into collection? So it looks like credit card went into a charge-off status. That's what I'm assuming is what it sounds like here. And are you now blacklisted? It's a little
Yeah,
bit outside
so
of the area, but let's take a stab at that one.
no, it's a fair question, and well, just before I answer it, I want to make it clear. There's over 10,000 companies in this country that issue credit cards. I mean, when we think of credit cards, we think of like 5 companies, right? Amex,
Yeah.
Discover, Cap One, and but every credit union out there can issue a credit card, and there's thousands and thousands of credit unions. So
Right.
I can't answer it and represent that all of them feel this way. However, having said that, there are absolutely credit card issuers that have a very, very good memory. And if you've
Mm.
ever defaulted on a balance with them and didn't pay them back, or if you discharged debt through bankruptcy, they will never do business with you again, even if you have fantastic credit scores someday
Yeah.
down the road. So that
Right.
is absolutely true. But the good news is that you got a whole bunch of other options.
Hell hath no fury like a credit card company scorned. All right,
Fact.
let's take the
That
next
is
one.
absolutely true.
From Rebecca, why does my credit score drop when I pay off my credit card balances? Okay, this one is very interesting. Um, I'll let you jump into that one.
Yeah, so knowing what I know about credit scoring systems, that shouldn't happen. It's not. Those two things are not correlated. Paying off
Yeah.
a card, score going down. It actually the opposite is true. So when you pay off your card, your score should actually go up. Now, there's a couple things I want to keep in mind. You may be attributing a drop in score to something that's not actually causing your score to go down. It may actually be something else that's causing the lower score. And another thing to keep in mind is that just because you pay off your card doesn't mean that it's necessarily going to show up as a zero balance on your credit reports. Remember, the credit reporting agencies only get an update once a month from your credit card issuers. And
Right.
so it's likely going to be based on the previous month's statement balance. And so while you may pay off the card or pay the card down, what's important is what it ends up looking like on your credit report as to how it's going to impact your score. So I'm a really good example of this. I'm what's called a transactor in the eyes of a credit card issuer. I don't carry balances from month to month. That's called a revolver.
Right.
And so even though I always have a balance on my credit reports because I use my cards a lot, I never ever pay interest and I never revolve a balance, but I never also have a zero balance on my credit reports.
Gotcha. Okay, so the short of it looks like it's just maybe not considering when the reporting date is, and like you said, perhaps she's got a balance that's all the way up. Now, this happens a lot with people who have maybe lower limit cards, like a lot of secured cards. I'm not saying that this is what you have, Rebecca, but maybe it's a $300 secured card and you paid it off, and then you went out to Ruth's Chris, and the bill was $296, but that zero balance when you paid it never got made its way over to the credit report.
So look, this doesn't need to be a mystery. I mean, there's a roadmap to why your score isn't higher for every single one of us, and every single time your credit score is calculated. People tend to forget that when a score is calculated and delivered, the deliverable is not just the 3-digit number. It's the 3-digit number plus the 4 factors. And the 4 factors are specific to why that particular score wasn't higher. And so if you have a score that has gone down 1 month and you have the same score from the same source from the prior month, compare your score factors and see what's changed, and perhaps it's going to identify something else that is the reason why, or the culprit as to why the score went down.
Got it. Okay. All right, let's move on to the next one. All right, hold on one second here. Okay. All right, so from Robin, do closed accounts lower your FICO score? Example, if a company closes because of going out of business, or a car is paid off or refinance, I think is what she's asking, and that account is closed.
So that's certainly possible, right? So I'll do a credit card example, and then I'll do an installment loan example. So if you close a credit card, the Warriors group knows their stuff, and it's probably very likely that they know that closing a credit card has a possibility of lowering your score. So that's a great example of why closing account doesn't matter who closes it. It could be you asking that it be closed, or it can be the issuer closing it without your knowledge or request. But the fact of the matter is it's now closed on your credit reports. And when you lose the value of the unused credit limit, your utilization ratios can spike and your score can go down, even if you've done nothing at all wrong. So that's the credit card example. The installment loan example, and your question is actually a really great example, because in your question, Robin, you have refinanced a car loan, which means that you took out a new loan to pay off a pre-existing loan. And so what you've just done is you now have a pre-existing loan that has a zero balance, and hopefully it's in good standing, which is great. But you also now have a brand new loan that has a balance greater than zero. The balance is not the issue. Balances on installment loans are almost irrelevant in credit scores. But what you also did that you probably didn't think about is that you added a new account to your credit report, which is going to lower the average age of it's called average age of trade. You've just lowered the average age of trade. And I got to tell you, people really ignore the impact of the average age of the accounts on your credit report. People really tend to focus on derogatories and utilization and inquiries. For some reason, people obsess about inquiries, but they tend to completely glaze over the metric that considers not only the average age of your trade, but also the oldest trade line. And so those are some things to keep in mind, that when you start adding new things to the credit report, you're lowering that average age of trade, and that's more impactful than people may think.
Got it. Got a question from a viewer here. This is a good one. This is sort of relates to what you were talking about. Unfortunately, there's not a name to it. By the way, I'm hearing we're having a little bit of an issue with the broadcast going up, playing live. We have some people who are commenting, not seeing their names, and David over here just handed me a note letting me know that looks like it might be not working on. It's working on desktop, David. Is that right? Not correctly, huh? Okay, so Sam just posted. Sam, are you on mobile or are you on desktop? The only guy that looks like he's able to get in here is this guy, is Sam. Okay. All right. Well, at the very least, worst case scenario, John, where I'm on Android and video and sound is good. Yeah. So I'll have to dissect this one a little afterwards. I'm not exactly sure what's going on. Hold on one second here. Sorry, but bear with us. It looks like we're having some kind of a technical issue, but at the very least, John, we're recording this, so we'll be able to post it. Yeah. So we're getting.
Yeah, the information will still be good tomorrow.
Yeah. Okay. All right. I'm on mobile and you can hear perfectly. Yeah, I'm not sure what it is, but we have a handful of people who are not having any issues with it. Thank you so much for adding that. Okay, I know that question disappeared, John. Let me go back to it.
I think
we'll just roll with it, and we'll post the video later, and we'll dissect I'll figure out what the issue is a little bit later on. Okay. All right. Is it true that your overall file is more important than your score?
Yeah. So I don't think I would assign more value to the file than I would the score. I mean, certainly most lenders in this country are going to pull a score. So this is almost one of those what came first, the chicken or the egg arguments, right? You can't have a credit score without a credit report being generated, but you can have a credit report without a credit score associated with it. All right.
Right.
So think of a credit score as like the leather interior to your car. It is an upgrade or an option that lenders pay extra for when they buy a credit report. But you can't just buy a score, because you can't just buy the interior. You got to buy the whole car in order to get the interior. So as far as what's more important, if you're getting a score, you're also getting a report. So from that perspective, at least the deliverable is there. You have literally hundreds and hundreds of different scores, hundreds, right? We tend to just focus on FICO and VantageScore and the multiple generations of those models that are available. But you have so many scores that you've probably never heard of that are generated from custom developed scoring systems that are used by lenders and insurance companies. And you'll never see them because no one's ever going to share them with you. But guess what? They're all based on one of your 3 credit reports. So in that respect, I would argue that the credit report is more valuable because it's the basis for every single one of those many, many scores. But I wouldn't discount one over the other. Look, in order to improve your score, you've got to improve what's on your credit report. So in my mind, it's a whole lot easier to manage to the credit report than it is to kind of chase a bunch of numbers around that are all going to be different tomorrow anyways. But your credit scores are likely going to be very stable over time. So I wouldn't take my eye off the score, but I also would tend to focus on actually the core reason why your score is what it is, which is the file data.
Excellent. Great answer. Okay. Let's see. So no questions really in the feed. I can see. Hold on. Okay, we're just having people letting me know that everything looks good. They can see us. All right, let's go on to the next one. Oh, nope, we did that. Let's go over here. Feisty. I think I got a couple of questions from Feisty. All right. My 5 credit cards, no installment loans, 98% on a payment on time, and utilization at 30%. How can I boost my score other than getting my utilization down? Even when my utilization has been low, my score still does not gain a lot of points at a time.
Okay, so that's actually, you've kind of triaged the problem to some extent. If your utilization is 30%, and if you're able to lower your utilization and your scores really aren't going anywhere, then utilization isn't your primary issue. It's something else that's the issue. So it seems like that you keep fixing a problem that isn't really your primary problem. So A, keep the utilization as low as possible. I think we all know that that's important. There's a couple of other things that that are important to address here. A, if you don't have installment loans, you're not maxing out the points in the diversity category. All credit scoring systems have a diversity category that rewards you for having experience with a lot of different types of accounts, including installment loans. So the fact that you don't have any installment loans, meaning you're not maxing out that diversity category. So that's number one. Number two is 98% on-time payments suggests that 2% of your payments are not being made on time. And I don't know what that means. I don't know if that means that 2% of the time you're 90 days delinquent or you're a half. I don't know what that means. So it certainly, that would be great if that was 100% on-time payments, and then this becomes almost a non-issue. Then there's a third thing that I'd like you to keep in mind. As people tend to focus on utilization, one of the great myths, well, there's a lot of them, but one of the more common myths in the world of credit scoring, especially that comes out of kind of the blogosphere, is that utilization is worth 30% of the points in your score. And so people tend to really assign a lot of value to that utilization ratio. Utilization is not worth 30% of the points of the points in your score. It's in the category that's worth 30% of the points in your score. There are a whole lot of other things in the same category that people tend to completely ignore because they focus only on this utilization ratio.
Right.
One of the other metrics that's in that category is the number of accounts with balances greater than 0. So to the extent that your utilization of 30% is coming from a bunch of credit cards, that's also a problem. If you have 30% utilization, but on fewer credit cards, that's actually better because you're performing better in some of the unrelated metrics. So hopefully that gives you some ideas, Feisty, as to maybe to trying some other things rather than just kind of focusing solely on the utilization ratios.
Got it. All right, good answer. Next one. Kristen, I'm looking to purchase a home this year. How long do I need to wait after paying off collection? So it looks like Kristen's coming around and she maybe got some advice from her mortgage broker or underwriter that things have got to be paid off.
That's right.
Let me move this down a little bit. It sounds like the question is, how long is it going to take for the negative effect from collections to subside?
Yeah, so obviously your mortgage broker is going to be able to answer the question from a policy perspective. You know, how long do I have to wait from a policy perspective before I can apply for a loan? From a scoring perspective, the answer, unfortunately, as it pertains to credit scoring, a lot of times is it depends. And it's going to depend on the type of collection. If it was a medical collection that now has a zero balance, the contemporary scoring systems do not consider it any longer, meaning it ignores them. The problem is that you're looking for a home, which means that you may be looking for a Fannie or Freddie backed mortgage, which means FHFA is mandating this ancient FICO score that still does consider collections, medical collections that have zero balances. And so here's, you're kind of damned if you do, damned if you don't. You did the right thing, paying off the collections, and so you don't have that issue, bugging you any longer. But the problem is that you also have the issue of some of these older models. Here's a suggestion I'd make, and I don't endorse mortgage lenders. You choose who you want to choose. Maybe look at a local credit union. And the reason I suggest that is there's a possibility that the credit union may not be beholden to Fannie Mae or Freddie Mac, and they may be actually just what's called warehouse your loan on their books, which means they can use whatever credit score they want to use. They don't have to listen to FHFA. And in that case, I can guarantee you they're not using these 20-year-old FICO scores. They're using the more contemporary versions of their score. They may be using a Vantage score because they can use whatever they want. But those models are going to treat you better if you do, in fact, have paid off collections than some of those really old models.
Great. Excellent. Okay. Sam, we got a big question from, oh boy, I can't post that one. It's such a long question. Sam, you and I have to go back and forth on email because you've got some pretty deep questions. I want to make sure they get answered. All right, I thought I saw one going up. Hold on. Now this is a little random, but let me throw this your way, John. Let me know if this is something that. Let me flatten that out a little bit. Okay. Can you read that?
Yep. Do you want me to read it, or do you want me to just answer it?
Well, I think everybody can read it. Yeah, if you want to. I just want to make sure you can read it so you can address it.
Oh, can you put it back up there?
Yeah. Yep. There we go.
All right. So I don't know what kind of credit reports you tend to see or look at, but there are two types of credit reports, and a lot of people don't understand this or know this. One is what's called a credit report disclosure. And the disclosure credit reports are the ones that you have access to as consumers. So these are the ones that you're getting off of Annual Credit Report, Identity IQ, Credit Karma, annualcreditreport.com, the credit bureau's websites. Those are all designed for consumer consumption, all right? Then there's the actual real credit report that is scored and is provided to lenders or users, and those are just called credit reports, and those are in what's called Metro 2 code. So if you actually saw your credit report in native format, it's just a bunch of comma delimited alphanumeric characters. Of course, the disclosures are meant for me and you to read, and so they're color coded and there's legends and they're laid out nice and pretty. So in Metro 2, it is a requirement that all of that information that you just listed is also included with the reporting of a collection, including the original creditor and a variety of dates and a variety of portfolio type code. There's a whole lot of stuff that's a requirement for a third-party debt collector to report something to a credit bureau. If they don't report all that stuff, the bureaus will kick it out and not allow it to be posted. So you may be looking at a disclosure style credit report that just isn't displaying that information, but I can assure you that it is in fact there.
Got it. All right. Let's go down to the next one. Oh, okay. We got that one already. Feisty again. Is there such a thing as having too many credit cards? And is it smart to only charge on one card at a time, charging on all cards, but put them in rotation so a balance is reported each month? Good question.
So I'm going to answer this kind of from the middle out. And is it smart to only charge on one card at a time? So, Feisty, I don't know what scenario you're in credit-wise, but generally speaking, it's better to have balances on fewer accounts than it is to have balances on more accounts. And so to the extent that you have 1 or 2 credit cards that are your favorite cards because of the rewards programs or whatever it is about the cards that you like, use them for everything. But you do want to make sure that you do throw some love to all those other card issuers, because they will eventually start lowering credit limits or closing the accounts if there's too much long-term activity. So I do like the idea of putting them kind of on a revolving door type of scenario. That doesn't mean you have to use every single one of them every month or two. But buy socks, period. Fill up your car, pick up your dry cleaning. Do something. Pay for dinner one night just to get some activity on a card that hasn't been used in a few months. Just so it kind of resets the clock of activity. So now I'm going to answer the first one. And financial planners do not like the answer that I'm going to give you, but that's okay, because financial planners aren't credit scoring experts. No, there is no such thing as having too many credit cards. As long as you use them responsibly and you don't get into excessive credit card debt and you don't have nuisance balances all over your credit reports, there is no penalty in credit scoring systems for having a ton of. I have a gajillion credit cards. Doesn't mean I use them all the time, but I certainly have a lot of them. And you know what this acts like, David? This is utilization insurance, because I have so much unused credit limit that even if I go nuts one month and charge 5, 10, 15, 20 grand because of business expenses or family vacations or property taxes, whatever, my utilization is still going to remain very, very low because I have so much unused limit. And why do I have it? I have it because I have a boatload of credit card accounts. And that's not a problem. Again, financial planners think I'm an idiot. Dave Ramsey think that's horrible advice, but I'm answering it from a scoring perspective. Responsible use does not correlate with you only having 1 or 2 cards. You can have responsible use of a dozen credit cards if that suits your kind of usage patterns.
Well, unless you're liquid and cash rich, and you can pay cash for things, Dave Ramsey's advice when it comes to credit is generally not good, as a lot of us will attest to. All right, good answer to that. Okay, let's go into the post. Let's see. I know somebody, unfortunately, I can't see your name. There's some questions about collections and how to delete them. Again, just to reiterate, maybe you weren't on when I was when I first launched the call, but John is a credit expert, not a credit repair expert. So I just want to let you know that we will answer this question in the post after the video, but it's not something that I'm going to serve up to John because it's not really in his wheelhouse. Okay, let's see. John, how are you on the CARES Act? Is that a subject?
As it pertains to the FCRA amendment from the CARES Act and the credit reporting requirements, I'm very up to speed.
All right, let's roll with this one then. What do you think about this one? Okay, I read when COVID first started, merchants couldn't penalize consumers for late payments, rent, etc. Is there a way to get rid of payment? Okay, well, this is kind of a how to remove this stuff, but I think it.
No, I can answer it. We're good.
Okay.
So let me clarify what actually happened. So the CARES Act, which is 880 pages long, does in fact temporarily amend the Fair Credit Reporting Act. There's about a dozen or so pages in the CARES Act that amend the Fair Credit Reporting Act. As far as things like federally backed mortgages and federally guaranteed student loans, those were all things that were guaranteed. You could either ask your mortgage lender for some sort of forbearance and they would have to give it to you, and your student loans were automatically thrown into deferral or forbearance. You didn't even have to ask for that. The stuff that was not government guaranteed, which is the bulk of the debt in this country, so credit card debt, auto loan debt, personal loan debt, mortgages that aren't backed by Fannie and Freddie, private student loans, things like that, unsecured personal loans. If you asked your lender for what's called an accommodation, and that's a word straight out of the act, and they gave you an accommodation and you lived up to your end of the accommodation, then they're not allowed to report you delinquent to the credit bureaus. They had to report you as being current. So let me give you an example of what that is. And that's if you were not already charged off or in collections on the account. So in other words, if you were on time on the account, or maybe just a payment or two delinquent, but then you cured the account, and they cut you a break on the minimum payment, or they deferred some payments, or they made some sort of an accommodation, they waived fees, and you lived up to your end by making the payments under the accommodation, and they had to report you as being current. That's the language in the CARES Act. And the reason I say it's temporary, the CARES Act amendment to the FCRA is only going to exist as long as we are in a national emergency declaration.
Right.
So President Trump declared national emergency. Now we have President Biden. And so as long as President Biden does not essentially declare that we are no longer under a national emergency, then those CARES Act provisions to the FCRA will still exist. There's nothing else in the FCRA that is temporary like the CARES Act amendments. And so eventually, when this COVID thing, I mean, who knows when that's going to happen, but I would imagine that someday that COVID will be a memory, and whatever president or administration is in power is going to say, okay, we are no longer under a national emergency declaration. Then I think it's either 90 days or 6 months, those CARES Act provisions of the FCRA are going to expire. So as of today, we're still in it and you're still good to go, but you have to have an accommodation provided by your furnisher.
Which is something that you have to ask for. Is that what you're saying?
Unless you have a federally backed mortgage or a federally guaranteed student loans, all other accommodations, you have to ask for them.
Got it. And I think somebody did have a okay, so I'm not sure who posted this. I'm sorry, I can't see your name. How is it that the student loan didn't partake in the CARES Act? And
if it's a private student loan, it wasn't automatic. You had to ask for it. That's right. If it was a government-backed student loan, yes, it was. You didn't even have to ask for it. It was just stop sending us money. But if it was a private student loan, meaning that the government doesn't back it, you can discharge it in bankruptcy, et cetera, your interest rates are higher, then you do have to ask for the accommodation.
Okay. Change the date. Okay. All right. Let's move on to. I think we might have done this one already. Yep. Okay. I think having too many credit cards. Okay. So those are the questions that we got in the post, and let me look into the post on the side. Okay. This is kind of credit repair stuff. Okay. Maybe the second part of this one, John, you could talk about. How do I get my first delinquent date off my credit report, and can the creditors change the dates on it as the account gets older?
So I assume that you're referring to the FCRA compliance date of first delinquency, or what's more informally referred to as the DOFD. And so I'm gonna run with that assumption because I think that's what you're probably what you're referring to in the question. So collection accounts and terminally delinquent trade lines, which are not the same thing, both have what's referred to as a DOFD, or date of first delinquency. They mean different things in the two different scenarios. For a collection account, and I'm referring to third-party debt collections, so Midland, PRA, I'm talking about those guys, not an account with Wells Fargo that's in collection status with Wells Fargo. I'm talking about those that have been outsourced to a third-party debt collector. There are two relevant dates on collection accounts: the date opened and the date of first delinquency. The date opened represents the date that the debt was assigned to the third-party debt collector. That's also the date used by FICO scoring systems to determine the age of the collection account in the scoring process. The date of first delinquency, or the DOFD, has one purpose and one purpose only. That date acts as the date from which the 7-year clock begins ticking for obsolescence. In other words, the date that the credit bureaus are eventually going to have to delete the collection. Some people refer to it as the trigger date. Some people refer to it as the anchor date. Some people refer to it as the DLA, even though there's no such thing as a DLA on credit reports. Regardless, it all means the same thing. It's the date from which the collection must be purged. That date must predate the date open. You can't have an account assigned for collections before it's even been delinquent, all right? So the DOFD has got to be older than the date opened. That date cannot be changed to be more current unless it is reported erroneously by the debt collector. Certainly it can be corrected and made more recent, but if it's made more recent improperly, that is the universal definition of re-aging, and you can't do that because it won't cause the score to be lower because that's based off the date opened, but it will cause it to remain on your credit report longer than allowed by law. All right, so that's collections. Trade lines. So trade lines that have some form of terminal delinquency, like charge-offs, repos, foreclosures, settlements, things like that. Those also all have a DOFD, or a date of first delinquency, because the credit bureaus need that date from which to start that 7-year clock. That date serves dual purpose. Number one, the purge from date, or the trigger date, or the anchor date, same date. And then two, unlike collections for trade lines, the DOFD is also used by scoring systems to determine how old the delinquency is. So again, same answer here as for collections. That date cannot become a more recent date unless it's being corrected, meaning it was reported incorrectly and is now being corrected. If it is reported to be more recent than it really should be, that is, again, re-aging. And of course, re-aging, we know, is a huge no-no.
Right. Excellent. Okay, so I think we got time for 2 more questions. Sam,
all right,
great job. Sam posted a question that we can get on the screen and answer, and it's a really good one. Great job, Sam. What do you want people to know about credit scores that most people get wrong or have no idea? That is a deep well right there.
No. I think there's 2 of them. I think there's 2 myths that are pretty prevalent in the world of credit scoring. Actually, there's a ton of myths, but I'll give you a couple of them. There's no such thing as a 0 credit score, and I think we all know where that comes from. There is no numeric 0 credit score. That's baloney. Number 2, and this one's a pretty common myth, and this one's hard to kill for some reason. Credit scores aren't used by employers. So you see a ton of incorrect information floating around in the blog world about, I didn't get a job because my score's too low, or, I don't want my employer to see my credit score. And you'll see it coming from reputable news outlets also that refer to credit scores being used for employment. That's absolutely incorrect. Credit reports can be used for employment screening. The style of reports that are sold by the credit bureaus for employment screening purposes is a different style of report that is sold to lenders. It's not the same style. It's called a credit report, still called the same thing, but it's definitely not the same style report. One of the differences is they do not deliver scores along with that report. So whenever you see someone talk about how they didn't get a job because their score was too low, negative. It was because something on their credit report was problematic. So that's a pretty common myth. Another myth that again seems to have a life unto itself is that when you close credit cards, that the reason your score goes down is because you lose the value of the age of the account in your score. So you see a lot of advice, hey, if you're going to close your cards, don't close your older ones because your score will go down. That's not why your scores go down. The date opened for a closed credit card is the same as it would be if it was still open. So as long as the account is still on your credit reports, then the age of the account is still being considered in scoring systems, whether it's open or closed. In fact, closed accounts continue to age. So if you have a 10-year-old American Express card and you close it today, next year on this date, it will be an 11-year-old American Express card. So the reason your scores would go down if you close credit card accounts is because of the loss of the value of the unused credit limit, not because of the age or losing the value of the age of the card. So those are some common myths.
It's what you're talking about a second ago, how having lots of cards is almost like utilization insurance.
That's right.
Got it. Okay. Very good. Let's see if we got one more in here. Oh, one thing, John, you said you were going through some of the posts in Credit Warriors, and a lot of questions about collections. So why don't we wrap up with this one?
Okay.
So can you explain the process of how debt collections end up on a credit report, why they cause scores to go lower, and what are the relevant dates and fields that people should consider on a collection account?
Yeah, that's a good one. So what generally happens with the collection issue is you have some sort of an account with a service provider, a property management company, or a legitimate creditor, and you go into default on that obligation. Your dentist office is not set up to chase you down for payment. Your property manager is not set up to chase you down for payment. While your lender is certainly set up to chase you down for payment, they're eventually going to wash their hands of it. And so they're going to outsource or consign, kind of like what you did with your prom dresses in high school. You're going to consign that to a different company so that they can take care of that stuff for you. And those are referred to in the law as third-party debt collectors. And so that's going to be your PRAs, and that's going to be your IC systems, and that's going to be your Midland account management style companies. All right. So what happens is these debts are assigned to these third-party debt collectors. I'm not going to talk about debt buying, where the debt collector, where there's a purchase of the debt, and now the collector is the new creditor. I'm just talking about the assignment or the consignment component. So when a debt is consigned to a third-party debt collector, that debt collector gathers a great deal of information from the original creditor about the account, about the consumer who is the obligor or the debtor. And then they will take that information and they will obviously attempt to collect the debt. Now they have a choice. They can do a variety of things once they have it. There's no requirement that they report it to the credit bureaus. That's a voluntary act on their part. They can just simply start sending you collection letters or start calling you and trying to collect the debt that way. Or they can report the debt to the credit reporting agency as a third-party collection account, which has to include many required attributes such as the date open, the date of first delinquency, the balance, the original creditor. These are all required attributes when they send something. Obviously, all of your personal identification information is because they need to be able to tie you with the debt. So all that stuff has to be sent to the credit bureaus. What debt collectors will do, which generally flies under the radar, debt collectors will actually use a collection scoring system, which is different than a credit risk scoring system. They'll use collection scores, which are also built by FICO, and they will essentially rank order all of those debts based on the likelihood that they will be paid. And so the ones that are more likely to be paid, obviously, are going to go to the top of the list, and those are the ones that everyone wants to work because they're going to be more easily collected. And then you have some that are at the very bottom of the list, which are highly unlikely to be paid. And those, you're not going to spend a ton of time trying to collect from those people because they're just simply not going to pay you. You may just report them to the credit bureaus and maybe eventually sue them and get a default judgment. And then maybe someday when they've got some money, they'll pay you. The rules about reporting collections have evolved. And one of the changes is that the original creditor has to be now listed with all collections. And if it's a medical collection, it has to be coded as a medical collection because medical collections are treated differently in credit scoring systems. And if your medical collection is paid by the insurance company or is being paid by the insurance company, then the credit bureaus have to delete them. So that's why they have to be coded as medical because there's different treatment of those. Some scoring systems, and this is all based on what generation of the score, which score brand it is. Some of the medical collections, even if they're unpaid, are discounted in scoring systems, not ignored, discounted, meaning that they're not as problematic as things like defaulted apartment leases or defaulted credit card debt. And of course, once those get to a zero balance, even though they can remain on a credit report, the contemporary credit scoring systems will ignore those. And so you could have collections on your credit reports and scores above 800 because once they get to a zero balance, the newer scoring systems are going to ignore them. Another change that's been made with the furnishing of collection accounts is now collectors are required to report those every month, meaning that they have to continue to report them and almost affirm that they're still valid collections. They can't just report them and then forget about them forever. Which is kind of the way it used to be done. The rules have changed, and now there's more rigorous requirements on updates from those debt collectors. And so that's generally how it works. I know people tend to dislike collection agencies because of what they do, but so the rules have kind of evolved around the stuff they're sticking on credit reports.
Excellent. All right. Really good information. I know we have a handful of questions here that didn't get answered. And This is something that we're going to do more routinely. Maybe we'll do once a month or so, once every other month. Maybe not with John only, but I have some other experts I intend to bring in. So for everybody that joined us today, thank you so much. And please do post your questions in the live. Just because we're done with the live portion of this doesn't mean that we're not going to swing back around and answer your questions the best we can. There's a great group that has the opportunity to come in and answer those questions for you from Supreme's group. And if you have questions for me, I'm happy to answer them. And John, thank you again so much for joining me today. And we'll look forward to the next Facebook Live on the Credit Versio page. And if you guys have any questions about that, there's a link in the description, and feel free to ask if you do have questions. Okay, thank you very much. John, thanks again, and until next time.
My pleasure. Thank you for having me.